Today, we're backtesting the 10-month simple moving average timing model, one of the most cited timing rules in finance. We'll compare it to simply buying and holding the S&P 500 from 1994 through 2025. So, does this classic Faber timing model earn its keep, or is the opportunity cost too high? This is back-tested strategies, real tests, hard data, no spin. If you want trading ideas that have been pressure-tested in rigorous back-tests with clear assumptions and transparent trade logic, you're in the right place. Now let's define the strategy precisely. For this back-test, we're using daily bars on SPY from a professional data provider with prices adjusted for capital reconstructions, special distributions, and ordinary cash dividends. On the last trading day of each calendar month, we compute SPY's 10-month simple moving average, or SMA, using monthly closes, including the current month-end close. On the chart, it looks like a staircase instead of a smooth curve because it only updates at the end of the month, marked as blue dots, then stays flat until the next month-end calculation. Then we compare the current month-end close to the 10-month SMA. If the close is above, the strategy buys SPY using 100% of available equity. If the close is below, the strategy exits and goes to cash. If the close is exactly equal to the 10-month SMA, the strategy maintains the prior position. Each strategy starts with $10,000 of capital. The backtest window runs from the start of 1994 through the end of 2025 using full calendar years. That's over 3 decades of data, spanning multiple market regimes, from crisis periods to long recoveries, to sideways high-noise stretches. Signals are evaluated at the month-end close, and trades execute using the same bar as the signal, assuming a market on-close order. Every trade pays 1 basis point per side in costs. That's 1 basis point to buy and 1 basis point to sell. When the system is in cash, cash earns 0%. Canonical Faber implementations typically model cash as short-term treasury bills. BTS models cash at 0% to preserve a longer, uninterrupted backtest window and to isolate the timing rules contribution. We do not model taxes, advisory fees, platform fees, or financing costs. And our benchmark is straightforward. We buy SPY once and just hold it through the end of the test using the same data and cost assumptions. So does the 10-month model meaningfully improve results versus buy and hold? Or is it mostly a historical curiosity? Let's dive into the numbers. But first, a quick disclaimer. This video is for educational purposes only. It is not investment advice or a recommendation to buy, sell, or hold any investment. Any performance shown is hypothetical and based on historical data and specific assumptions. Past results are not indicative of future outcomes. Please pause now to read the full disclaimer on screen. All right, let's have a look at the scorecard and walk through the head-to-head performance metrics. We'll go section by section in the same order you see on screen. Section 1, Exposure. For the 10-month moving average timing model, time in the market is 78%. That works out to 0.6 trades per year, and the win rate is 65%. For buy and hold, time in the market is by definition 100%. Trades per year and win rate are not meaningful. The position is held continuously. Section 2, Risk. For the 10-month model, volatility is 12.8% with a max drawdown of minus 25.5%. The Sharpe and Kalmar ratios are 0.8 and 0.4, respectively. For buy and hold, volatility is 18.8% with a max drawdown of minus 55.2%. The Sharpe and Kalmar ratios are 0.6 and 0.2, so the model delivers materially better downside containment, and that shows up in cleaner risk-adjusted performance. Now let's see what it costs in compounding. Section 3, Payoff. For the 10-month model, the compound annual growth rate is 9.7% and ending capital is $193,146. For buy and hold, the CAGR is 10.7% and ending capital is $258,432. So the trade-off is simple, a smoother ride but a lower terminal wealth number. Now that you've seen the scorecard, let's look at how those results show up over time on the equity curve. The gold line is the 10-month model and the dark line is buy and hold. Here's the key visual to watch. When the gold line is rising, the strategy is invested. When it goes flat, the strategy is in cash. That design creates the core trade-off you see on this chart. Here are the high signal story beats. First, the crisis window proof points, because this is where the model earns its reputation. From the dot-com peak to the trough, the 10-month model is down minus 11.5%, while buy and hold is down minus 47.5%. From the global financial crisis peak to the trough, the 10-month model is down minus 6.1%, while buy and hold is down minus 55.2%. And in the COVID crash, the 10-month model is down minus 12.4%, while buy and hold is down minus 33.7%. That is the damage control claim in numbers, and it explains why the risk metrics improve. The 10-month model is a low-activity system, about 0.6 trades per year, with long, persistent holds when the trend is clean, and extended cash stretches when the month-end signal stays negative. In fact, there are full calendar years where the strategy is entirely in cash, 2001 and 2008. That's a big part of why the crisis drawdowns are so much smaller. The failure mode. And this is the surprise. The strategy's own max drawdown shows up in 2022 to 2023. And in that specific peak-to-trough window, the 10-month model is down minus 25.5%, while buy and hold is down minus 18.0%. So whipsaw is not abstract here. It is what happens when price keeps crossing back and forth around the moving average, and month-end confirmation flips the regime at the wrong times. The equity curve takeaway is simple. In sustained downtrends, this model can materially reduce the depth of drawdowns. However, in choppy markets around the trend line, it can lose to buy and hold even while spending meaningful time in cash. To recap, we've reviewed the head-to-head metrics on the scorecard, and we've walked the equity curve, highlighting how this trading strategy behaves over time. Now let's step back and summarize the benefit, the cost, and what role it could play in a portfolio. Benefit. The main benefit is drawdown control and prolonged sell-offs. When the month-end signal stays negative, the model can step out and stay out, and that is when the smoother ride shows up most clearly on the curve. Cost. The cost is two-sided, lag and whipsaw. A monthly trend filter can re-enter late after sharp bottoms, and it can also get chopped when price ranges around the moving average and the signal flips. Role. Given all of that, what role is the 10-month moving average timing model best suited for? Most plausibly, it's a rules-based trend overlay on top of a core equity allocation, designed to blunt the deepest drawdowns without leverage or short selling. The 2022 to 2023 window is the reminder that the key risk is not only missing upside, it's getting chopped up when price snaps back and forth around the trend line. At Backtested Strategies, we always include a short bonus section at the end of our videos for viewers who want a tuned variant of the same idea. So thanks for sticking around. For this 10-month moving average timing model, we ran a parameter sweep over the SMA look-back length, and one configuration stood out. We'll show the results right now. And to receive the tuned parameter pack for this test, go to backtestedstrategies.com/10month. The link is also posted in the video description. We'll go section by section using the same grouping as the scorecard. Section 1. Exposure. For the standard version, time in the market is 78%, with 0.6 trades per year and a 65% win rate. For the tuned version, time in the market is 78.2%, with 0.5 trades per year and a 64.7% win rate. So participation is basically unchanged, and the tuned version trades slightly less often. Section 2. Risk. For the standard version, volatility is 12.8% with a max drawdown of minus 25.5%. The Sharpe and Kalmar ratios are 0.8 and 0.4, respectively. For the tuned version, volatility is 12.9% with a max drawdown of minus 20.8%. The Sharpe and Kalmar ratios are 0.8 and 0.5. So risk improves where it matters most. Max drawdown gets materially smaller and Kalmar improves, while volatility holds steady. One more behavioral point that matters. The standard version's max drawdown comes from the 2022 to 2023 whipsaw window, while the tuned version's max drawdown shifts to late 2018. So the tuned version reduces the damage in the 2022 to 2023 regime, but it does not eliminate drawdowns. It changes where the strategy is most vulnerable. Section 3, Payoff. For the standard version, the compound annual growth rate is 9.7%, and ending capital is $193,146. For the tuned version, CAGR is 10.3%, and ending capital is $230,098. So the tuned version improves long-run compounding meaningfully, while also reducing max drawdown. The takeaway is not that there's a single magic setting. These results are specific to this SPY history and this exact set of assumptions. The point is that small, systematic parameter choices can materially shift the balance between return, drawdown, and trade frequency. Remember, go to backtestedstrategies.com/10month to get the tuned parameter pack for this backtest. We'll email you the exact settings and implementation notes. Click the video on screen to watch the next backtest and subscribe for future episodes. Thanks for watching Backtested Strategies. Real tests, hard data, no spin.